been our bread and butter across Europe for the last 3 years, buying or selling land on behalf of data center operators, or actually, owners of land, where we at Knight Frank identify viable land plots by mapping, the power and the fiber availability, and also, flood risk, flight path risk. But what's key is the relationship we hold with the data center operators. We do know where the likes of, Microsoft, AWS, and Google house their availability zones. So we can very much hone in our locational searches in terms of where we can look for data center development land. And the blue outline here was an asset we sold to a cloud provider about a year ago, 16.5 acres. But the reason it traded so well, so the existing use value was about 50 million, and it ended up selling for 150 because we secured a positive planning consent and a formal power offer from the distributed network operator. But it was located near the Microsoft and Amazon availability zone, and it was right by the train tracks, which house the Zayo bullet line, we call it, which is the sort of fiber line that takes data from London out to Bristol and then across the ocean to New York. So it was massively attractive. And once you create that operator competition, because the areas you can buy land in are very slim, there's very much a bidding up process. And given the revenue they're generating from a big facility like this, it's all about trying to get the data center operators not what they want to pay, but what they can, afford to pay on the selling of the land side. But often when we're trying to identify land parcels, we'll find a viable land plot, and then the first thing we'll do is take it to our architects. We've got an exclusive mandate with Nicholas Webb Architects, and when we've found a viable land plot, we'll give it to them, having spoken to a planning consultant to understand what heights we can get at the facility. But essentially, the key now in the market is scale, because an operator will very rarely buy land if they can't provide at least sort of, depending on which market, but sort of 15 to 20 in Europe. It's probably more like 10 to 15 in tier 2 APAC markets. But they need to be able to show their cloud customer, Amazon Web Services or Google, that they have enough runway within that facility to move into it. So, when I first joined the sector, the standard cloud deployment was about 2 megawatts in year one. We're now at essentially 8 megawatts in year one. And the other day we saw a cloud service provider lease the entire 25 megawatt facility off an operator at day one. So you need to be able to, provide at least 15 to 20 in Europe. And that's about 15,000 to 20,000 square meters on a GLA or GIA basis, whichever you want to call it. So from a cost perspective, this is where the operator has to get things right, because of the fit out of a data center, building a shell is very easy, and it's actually not massively different to building a multi-story industrial shell. But your fit out is circa $10 million per megawatt of IT capacity. So, an average size data center at 20 megawatts now, the fit out is going to cost you north of $200 million. So that's why there's so much attraction towards the sector, because you can invest a huge amount of capital in, 20,000 square meters GIA. Once we've designed a viable scheme, we don't just buy the land, we'll negotiate power contracts alongside the distributed network operators, because a lot of these data center operators, they're not real estate savvy businesses, they are tech companies. So they need to work alongside landlords or with advisors such as Knight Frank in order to do the legwork and to pre-position the assets. But once you have done that, you can then charge a premium on its existing use value on the land. So the 20 megawatt facility that I mentioned on the previous slide, if that was fully let at a sort of standard European cloud rent now, the revenue off that one data center building would be around $14 million per annum. So the rental income they generate is large. And actually the land is often, 5 to 10% of the gross development value of the actual building.